Okay, good morning everybody. It's 11 o'clock. We should get going. Richard's actually going to be doing most of the news this morning because it's all property stuff. But I'm going to be talking to Nicola Takada from AVI Japan Opportunity in a second. But first of all, I'm going to talk about M&G Credit Income first because it is one of very few funds that is issuing stock. And it's a reasonably small fund, but it's been quite successful. I mean, I know that chart doesn't look very exciting, but the main point of this is it's a debt fund that is designed to deliver a decent yield, and it's been doing that job. And after a sort of initial wobble where it went to a premium and then came back again and it sort of stabilised, and it's been trading fairly close to asset value for most of the past 5 years. And more recently, it's been trading fairly consistently at a premium and being able to issue stock. So it's been reissuing stock that it bought back when it was trading at discount. So it's now, I think, done all of that to 12.7 million shares. And it's got permission to issue up to another 31, and it knows that there's demand for it. And obviously, we'd quite like to be a bigger, more liquid trust. So they're going to do a placing and a retail offer at NEV plus 1%. But because there's no stamp duty, that means that you're buying them probably slightly cheaper than you can buy them in the market, I think, at the current price. We won't know actually what the issue price is until the 18th of March because it's based on an NAV just before then. And then you'll be at the last time you can apply for these is at 2 p.m. on the 20th of March. So, but if you wanted to apply for them, you have to get the orders in sooner than that. And the results will be announced on the 21st, and new shares will start trading on the 25th. Now the placing bit, I thought this was really interesting. I know there's a great chunk of legalese on the screen there, but they're basically trying to avoid issuing a prospectus. Now the requirement to issue a prospectus is so expensive and so confusing for everybody. Nobody pays much attention to it. It's a huge waste of time. Basically, what they've done is, if you're an institution, if you're a professional investor, and you want to invest, you can't just put an application form in. You have to be contacted by Winterflood. So they will have a list of people that they already know there's have got demand for these shares, and then basically they sign their life away, say that I made this decision by myself, nobody influenced me to do it, and somehow that avoids the need for a prospectus. And to my mind, this is what the market should be like almost all the time. Basically, if you're going to buy something, you do the due diligence, you make sure that you're happy with the risk involved, and it's on you if it goes wrong. And the world would be so much more simpler if that was the way it just worked. So this is the whole sort of Latin caveat emptor buyer beware stuff, which is the way the market used to work many years ago. And there's been so many protections built into it now that it's just become staffed. So this is a way of getting back to that old situation. For the retail investors, the Winterflood has a thing called a wrap platform, and the details are exactly the same as they in terms of the price and the timing and everything else for retail investors. The minimum size you can invest is £100. But the maximum size of the retail issue is only €4 million, and this is one of these daft EU rules that we've imported into the UK and we've done nothing about since Brexit was years and years ago now, and still haven't got around to changing. And this must change soon. But the €4 million side is again it's the trigger where you need to do a prospectus. So that's what their cutoff is there. But because that number is quite small, there's quite a high chance that you might get scaled back, and there's nothing you can do about that, unfortunately. There's no way of kind of guaranteeing that you get a bigger share than everybody else. So anyway, go for it if you want to. We're not advising one way or the other. I did write about it for Questa a few weeks ago, and you can try and read that. It's on the Telegraph site behind a paywall. But I'm going to now hand over to Richard to talk about the property stuff.
Great, thanks James. Yeah, so another busy week. So a month ago now, Assura, I was on the show talking about Assura, who had a bid from KKR and USS, which was rejected. So KKR have come back now with a different partner, Stone Peak, another US company, and put in a bid at NAV, which, well, just below if you take away the dividend, which is included in the price, which the board has said they're minded to recommend if that offer is firmed up. And then at the same time, Primary Health Properties, which is another UK listed primary healthcare property company, does exactly the same as Assura. And I think I did mention when I was on the show last time that it would be interesting to see if they come in for a merger, and that's exactly what's happened. So they've been in contact with the board to talk about a merger opportunity. Now Assura says that what they've been talking about is would value them at 43p, which is obviously well below the KKR bid. But PHP came out and said actually we've not really discussed the conversion ratio and things like that yet, and they seem really keen on doing a deal. So we'll see what happens there. It would make sense. Obviously, it's been sort of touted for a number of years that these two combine. It'll be a huge portfolio, so you get sort of cost synergies and all that from there. Reduced cost of capital and a strengthened balance sheet as well, and obviously being a much bigger company, there'd be increased liquidity in the shares and things like that. So there'd be massive benefits for both shareholders. So like I said, so the portfolio would be about 6 billion. The NAV will be just under 3 billion, market cap just below that. So it'd be a sizable company. So PHP has until 7th of April to make a firm offer. So I suppose watch this space really to see what happens with that. And then shareholders will have a decision to make, I suppose, whether they want to cash out now or carry on in a bigger form. And then, so another REIT, Care REIT, you can see what's happened there. On the right hand side of that chart, it's spiked up the share price, but you see the NAV there, that's the orange line, it's been really sort of consistent since it started. And that spike up has been because this week they had an offer which has been recommended by the board, so just under 450 million from Care Trust, which is a US listed REIT as well. It's massive, sort of 5 billion market cap, and it transpires that they've sort of been looking to come into the UK sector for a long time. Sort of been searching around for deals and things like that, and they first approached Care REIT at the end of 24, and they've been in sort of discussion since on a deal. So that's coming at 108p per share, which is a massive premium to the share price, because this has been trading at a big discount. But it's also almost 10% discount to the NAV, which seems quite a lot has been sort of left on the table there by the board. And it was funny actually, because that was announced on Tuesday, and then 2 days later Care REIT had their annual results come out, and they were pretty good. Like I said, been very consistent since it launched in 2017. So portfolio value is now worth sort of 680. Rent roll has been going up consistently because all their rents are CPI and RPI linked, with a cap on that. So they've been sort of nudging up very consistently. NAV's grown since it launched from 98.2p to now just under 120. Dividends has grown from 6p to 7.2p, and the annual NAV total return has been 9%, which is pretty decent considering what's gone on in the last few years, especially. And I just picked out a few bits from their presentation from their results. So, like I said, so top left there you see the accounting return for year 9.4 this year, 9 in total average since it launched. There's the rents ticking up every year, it's now just over 50 million. And then the bottom one is rent cover, which is quite a crucial thing in the sort of care home sector. It just shows the affordability of the rents that the care home providers pay Care REIT. and how much they obviously charge the underlying tenants, and that is 2.2 times, which is very good, and that you can see again that's been ticking up over the years as well. And then I picked out a couple more on the tenant side of the business on the next slide. So the top one shows bed occupancy. So it starts at around early 2020. So you see the impact that COVID had on the care home sector, and then that's just been grown, and now it's back up to pre-COVID levels. So normalised levels, sort of high 80%. And then the bottom graph shows, so the bars are the average weekly fees that they charge the underlying tenants, and that's obviously been going up. The top line is the rate it's been going up at, and the bottom line is inflation. So you can see that they've been able to charge tenants above inflation rates, and that's because of the demographics in the sector. So we all know ageing population, supply and demand of this isn't great either. So you had this sort of weird juxtaposition of actually the board and the manager said they're going to vote in favour of this, and then 2 days later coming out and saying how brilliant the sector is and how brilliant the portfolio is, which I agree with, and yet they're recommending an offer that's 9.4% below the NAV. So for me, it doesn't make sense, and we'll see what shareholders think of it when the general meeting is announced and they get to vote on it. It needs 75% of shareholder approval. We'll see if that happens. To my mind, it's a lot of value being left on the table there, but we shall see. So urban logistics, just quickly, I was talking about them last week when they announced plans to internalise their management. And this was sort of one of the companies that had been touted as a target of Achilles, which we again talked about a few weeks ago when they launched. So it's the guys behind Harwood Capital who helped with hypnosis, and behind the strategic review at PRS REIT as well. So they raised 54 million. They're looking to go in as an activist effectively and go into companies that are trading at wide discounts and try and get value there through lots of different avenues. So this seems to be their first target. So Urban Logistics REIT, they now own 3.2% of the company, and we shall see how they're going to engage with the board and see what kind of strategies they're going to look to sort of bring that discount in. But it obviously set out the rumour mill because the board felt it needed to come out with a statement this week, just saying that speculation on corporate activity and there's not been an actual approach or anything like that, and they would make an announcement if there was. So we shall see what happens there. Be interested to see what happens. And then Life Science REIT is the last one I'll talk about. So they've had a really tough time. They launched, it was the last REIT to launch actually before it all sort of started going south at the end of 2021, and they've struggled ever since really, which that chart shows sort of discount is now 50%, which obviously isn't great. So they've announced this week that they will launch a strategic review. They'll look at all options: sale of the company, manage wind down, look at consolidation, or even amend their investment strategy. It seems like they want to sell, if I'm honest, because they've talked about they've had a number of discussions with potential suitors, and they believe it's a sort of attractive business for parties to come in and bid for. So again, we'll see what happens there. Just on the next slide, just sort of go through what's happened with this company. So yeah, like I said, it launched in late 2021, and it's focused on the Golden Triangle, they call it. So that's between Oxford, Cambridge and London, and it's really where all the life science companies base themselves, obviously for the talent coming out of the universities there. And the premise was to provide the lab spaces that these companies need. And also one of the things that they could really get advantage from is converting office space, which, as we know, has been sort of under the values of the rent that you can get on that is sort of been depressed over the last few years, and convert that into lab space, and then let that out at much higher rates and get a really good, decent return on their investment there and the development and refurbs and things like that. It just hasn't panned out that way. There's been lots of issues. They obviously, as soon as they launched, or a few months later, the interest rates went sky high, and they've not been able to. The share price went to a discount, and they've not been able to raise any more money or do any of the things that they wanted to do. And also the life science sector has also sort of fallen back a bit. The venture capital funding's fallen back a bit since the post-COVID high. So the demand side is still there, but not as strong as it was. And like I said, they've not been able to fulfill a lot of their the strategic promises from the start. So we've seen the discount widen to, like it is now, 50%, which isn't sustainable. So we'll see what happens here. I would imagine that someone will come in with a bid and get a nice sort of premium for where the share price is at the moment, hopefully.
Thank you, Richard. Yeah, it's a shame they're all disappearing, these funds, but there we go. Great, so that's enough on the news side of things. Let's now bring in Nicola. Good morning.
Morning.
Thank you very much for doing this. New face for AVI Japan, but
Yes.
I'll let you introduce yourself and tell us a bit about the fund, please.
Sure. Thank you for having me, first of all. I have been brought on to help sort of bolster the Japan investment team, which is currently about 8 people. I have been doing Japanese equities my entire career. Before I joined AVI, I was at Redwheel working on their Japanese engagement strategy there. And before that, I was at Mizuho Securities and also Goldman Sachs in Japan, working out in Tokyo. And in terms of the AVI Japanese Opportunity Trust, I thought, James, it might be worth sort of taking a step back a little bit and sort of giving a bit of background as to why AVI even has a Japanese dedicated strategy. I think a lot of people will be familiar with AVI's global strategy, the Global Opportunities Trust, which used to be called the British Empire Trust, which has been going for 40 years. And within that trust, there was always quite a heavy Japan allocation. And the reason for that is those who know AVI will know the types of companies or the types of opportunities that AVI looks for are to really try and find undervalued, mispriced opportunities in the market. So typically they will look at areas of the market that they consider undercovered or very badly covered, where they try to find companies that are trading at discounts and also that can be overcapitalized. And Japan, with the 4,000 listed companies that they have, is quite a rich hunting ground for those sorts of companies. And in 2014 and 2015, so we're going back 10 years now, I mean, the infamous third arrow of Prime Minister Abe was introduced. So anyone who's been following Japan at all will have heard a lot about corporate governance reform over the past 2 or 3 years, but that really started over 10 years ago. And at that time, AVI decided to incubate a Japan dedicated strategy, which worked very well, and launched it in 2018 as the AVI Japan Opportunity Trust. And why did they decide to do that? Well, people have been investing in Japan for a long time. A lot of people have been frustrated by Japan because even though there are these companies that on the face of it look really attractive, lots of cash on the balance sheet, trading at discounted valuations, and a lot of the time they're quite, decent quality businesses as well. Japan became the infamous value trap of global markets. So what was missing was really a catalyst to change that. And Abe's introduction in 2014 and 2015 of the corporate governance codes and the stewardship codes were really the first iteration of this catalyst, which has actually been going on now for 10 years. So I think you're in charge of driving with the slides, aren't you? If I could take you for, okay, great. So this is the team. As I mentioned, there's 8 of us. It is a pretty much bilingual team across the board. And what is interesting is that our team doesn't come from typical sort of investment analyst backgrounds. We have management consultants, ex-McKinsey and ex-Bain, and we have myself from investment banking. And we really try to build out this bilingual, bicultural type of team, which is very important for reasons I'll touch on in a little bit. So what's been happening in Japan, as you know, is that people have been focused on this corporate governance reform. Sorry, if you can go forward one more. Thank you. And people are thinking, okay, maybe things are now changing in Japan. And we would very much agree with that. There are a lot of opportunities for the kinds of investors who are really willing to do the work. It is a really unique opportunity. And I would say, having done Japan for over 20 years now, this is really like a once in a career, a once in a generation opportunity that structural reform is coming through. And there is a reason also that you may have seen a lot of headlines out there about private equity all over Japan. So they've been building out their offices and building out a presence in Japan for the past 5 to 10 years. But they too were waiting for a catalyst. And now it is the second most active market in the world in terms of corporate activity, because this sort of opportunity set doesn't really exist anywhere else. What kind of market do you have elsewhere which has 4,000 listed companies, half of which are trading below 1 times price to book? You've got about 1,000 to 1,500 companies which have more than 30% of their market cap in cash. And again, for those who are willing to do the work, it is a really unknown and undercovered market. About 60% of the market has less than 1 analyst covering them. So this was the opportunity set that AVI realized was there. And they recognized that this would be an opportunity that we probably won't see again. And that's why we decided to set up and launch the Japan Dedicated Strategy 7 years ago. If you could go down one, please, sorry. Thank you. So just to reiterate, this is what we look for in terms of companies, right? Under-researched, as I mentioned, there's a plethora of opportunities there, about 60% of the market. In terms of cash being structurally discounted, what that refers to is that, yes, there's half the market trading below 1 times price to book. And part of the reason for that is, again, historical. There have been so many attempts at trying to unlock that shareholder value, trying to improve capital allocation amongst Japanese companies, which have really come to nothing. But now with this changing environment, those assets, the cash assets and the non-core assets, which have been sitting on balance sheets with their valuations sort of being diminished to nearly nothing, they are starting to be valued, and they are starting to raise the valuations of these companies. And that is really something that attracts us and something that we try to work with companies to realize. As I mentioned, regulatory tailwinds. So yes, this started a decade ago with Prime Minister Abe. But what we have seen is, I think, something quite extraordinary, which is an amazingly coordinated and orchestrated effort by a number of different entities in Japan. So you have the government, you have the Bank of Japan, you have the Tokyo Stock Exchange, and you have the largest asset owners in Japan as well. So for example, the GPIF. All of them have embraced the corporate governance codes and the stewardship codes, and are really pushing from all directions onto these Japanese companies to try to get them to change. Very recently as well, METI, which is the Ministry for Economy, Trade and Infrastructure, they've put forward guidelines to try and educate companies on how they should deal with takeover bids and management buyouts. So again, this really feeds into this burgeoning private equity industry that we're seeing in Japan as well. I think, oh sorry, can we go back to the other slide? Richard, number 4 is really important. And again, having done this for a long time, I think this is the change that I've really seen on the ground with these companies. Because it is one thing to have an investor say to you, I've owned your shares for 6 months, I want you to give me back all the cash on the balance sheet. And to put up walls to that investor and say, actually, we don't even want to have discussion with you. But what has changed now is that a lot of these companies realize that they need to change. So it is not that you're pushing on a closed door. A lot of the companies are actually willing to speak to their shareholders and understand what it is that's important to them. And in terms of engagement, this is really, really linked to that previous point. When you come in as a company, so when you come in as an investor and you talk to a company, you know, it's pretty boring if you go in there and you say, actually, can you please just give us the cash back? Because that's what everyone says. And what we try to do at AVI is really look at it from the company's perspective. When we're meeting the executive management team, we're thinking, okay, what is it that keeps you up at night? What is it that you want to achieve over the next 5-10 years of this company? And more often than not, again, they understand that pressure that they're under. They want to improve their valuations. They want to improve their margins. They want to improve their profile amongst shareholders, but a lot of them don't know how. And we will go in, and again, this is where the management consulting background of our analysts is really important. We will go in there with a 70, 80-page presentation when we first meet the company, and we'll say, we've done all of this work on your company, and your company is amazing at doing X, Y, and Z, but if you want to improve your company operationally, if you want to improve your margins, these are the guidelines we can give you to do that, and we can help you do that. And then secondly, we also look, of course, at capital allocation, but what we're really trying to figure out is what does the company want to work with us on? And I think that's a big differentiating point between us and some of the other activists out there. Sorry, next. Keep going. Thank you. One thing is that we focus on mainly small mid-cap Japan. And why is that? Well, again, to repeat, you know, the sorts of companies that we look for, under-researched, that's mainly in small cap Japan. You know, everyone covers Toyota and Hitachi and SoftBank. You know, you're not going to find a lot of sort of hidden value or hidden gems within that portion of the market. Very importantly, they're also deeply discounted. Small cap Japan, as I mentioned, trades very cheaply, especially compared to their larger peers. And there's a lot to work with them on. So there's a lot more margin where we can really influence what the company is doing and how that impacts the valuations of the company. As an example, the Tokyo Stock Exchange recently has put together a now infamous name and shame list, where they've taken the companies and they've said, okay, what we want from you is we want you to show us that you think about capital allocation and working capital. We want you to understand what your valuations are, and if they are below 1x price to book, we want you to show us that you are taking steps to amend that and to raise your valuations. And one other thing that they've come up with as well is you need to disclose clearer information about your company, and you need to do it at the same time in English and Japanese, because otherwise foreign investors have no idea what you're doing. So within the small cap Japan, they are cheaper, they're less known, and there's a lot more to work with them on in terms of engagement. Sorry, next. Thank you. One other point about the small caps, which is sort of relevant at this point in time, is that historically small cap Japan has outperformed the large caps until 2 years ago. And what happened 2 years ago is that the yen experienced a massive devaluation, so over 30%. And what that did in turn is, of course, stimulate the earnings of the exporters and the large cap exporters specifically. So you had over the past 2 years a huge gap that has grown between large cap and small cap Japan. You're talking 27% outperformance by the core 30 names in Japan over small cap, which has been entirely driven by the weak yen. But what we know now, of course, is the Bank of Japan is looking to normalize their monetary policy. They are very aware of the issues that come from having a weak yen in terms of imported inflation, not just for companies, but also for the consumer. And so what we can expect to happen is gradually over time that the yen will likely start to strengthen again, and that could bring about a reversal in this massive outperformance that we've seen with the large caps. Next, please. This is just a timeline. Again, I sort of touched on this already, but just to reiterate the fact that all of these changes that we're seeing now have been a long time coming and have been in the works for over 10 years. So it's definitely not a flash in the pan situation. Next thing. You can actually go through these a bit. Sorry, Richard. Just keep going forward. Yeah. So these are some metrics just to show you that things really are changing. Buybacks are at a historical high, and that will continue. I saw something really interesting today, which said that for the first time in decades, that share buybacks in Japan are having more impact on the market than foreigner flows, which is incredibly encouraging. It means that, you know, the Japanese companies are buying back their own market, and that's a very healthy sign for the market as a whole. Cross shareholdings, which is a very Japan-specific phenomena, where, you know, they effectively act like poison pills. You own shares in your affiliate companies, in some of your suppliers and the supply chain, etc. And again, the Tokyo Stock Exchange has said that they are taking a very negative view of companies that have cross shareholdings for no reason. So we've seen a decline in that. On the top left, I wanted to highlight that, yes, that chart looks impressive in terms of number of shareholder proposals. However, you know, again, 4,000 companies and only 113 shareholder proposals. That means there is still a long way to go. We do get asked, you know, do we think the move has happened? And absolutely not. I think we are still very much in the beginning. Sorry, next one, please. This is just to highlight what the portfolio looks like. As I mentioned, small mid cap focus, because that's where we see the most attractive opportunity set. And I think in terms of the industry breakdown, this is really an output rather than an input. You know, we're not macro, we don't look at things top down, but it just shows that we are able to have a very diversified and accessible portfolio, even though we're focusing on the small mid cap market. Sorry, next one, please. Keep going. This is something to highlight in terms of how we do engagement. So I think we sit in a really sweet spot in the middle. We consider ourselves constructive activists, so the vast majority of our engagement is done behind closed doors. We will meet with companies 300 times a year. That's how many company meetings we do. I just got back from Tokyo last night, having done about, you know, I think we've done 50 meetings or something over the past couple of weeks. We are very intensive with our engagement. We are very full on. We take a lot of time to get to know the companies, a lot of time to understand the challenges and the blocks to increasing corporate value. And then we spend a lot of time working with that management in a very intensive way to try and realize that, value creation. There are times when we will have to push a little harder. And there are times, you can see it's a handful of times only over the 7 years of the life of the fund, where we will go public, where we feel like we have, you know, reached an impasse with the company, and we will take things a little bit more public. But for the vast majority of our engagement and our companies, we do things in a private way, private engagement. And what do we engage on? As I mentioned, operational improvements, capital structure. We still have a fortune basically sitting on corporate balance sheets around Japan, not just in cash, but in investment securities, cross shareholdings, and real estate assets. Sorry, next one, please. You can keep going. I think, sorry, keep going. Thank you. So this is the portfolio performance in yen, and the only reason I'm bringing this up is because, as I mentioned, we've seen a 30% devaluation in yen, which has eroded the performance of the fund in sterling terms. However, if we are to see a reversal in that trend, then that could work the other way and actually be a tailwind for sterling returns for the strategy. Next one, please. We have a highly concentrated portfolio. We build large stakes in our companies to ensure more effective engagement. The top 10 make up about 70% of the portfolio. And as I said, we do a huge number of company meetings. And it's not just with senior management, it's also, as I mentioned, with non-executive directors. We will meet with employees, we will meet with previous employees. We really try to get a very detailed and holistic picture of the companies that we're engaging with. And therefore, what are the issues and how do we pull the levers to make a more impactful engagement with these companies? Thank you. In terms of pipeline, we are finding ever more opportunities, partly because companies are feeling much more that they want to speak with us, that they want to change, that they want to have their hand held in terms of increasing their valuations. And that has really expanded the pool of companies which we are able to engage with, who we say are engageable. And we've already had 3 new additions into the portfolio this year. 2 of them actually in the logistics space, which has been a really interesting part of the market for us to work with. Next, please. Richard, I didn't know if you wanted me to go through a couple of case studies, but one thing I wanted to mention before we do that is I said at the very beginning about private equity in Japan. What has been really interesting is that we've seen that increased activity in a very real way within our portfolio. So last year, bearing in mind we only have like 22, 23 companies, 4 of our companies were taken out last year. And it's not an exit we look for necessarily, but as I mentioned, private equity are sitting there looking for just the sort of companies that AVI like to look at as well. And so it's quite, it's been incredibly powerful for us to have them sitting on the sidelines and know that they're at least active in the market now.
That's great. It would be cool to talk about some of these holdings, but before we do that, we've got some questions coming through already, so let's maybe take a step back a bit. So, interesting one, I thought. How do you feel the process, the experience of being an investment manager in Japan differs from being an investment manager in the UK, for example?
Oh. I think transparency is a big one. As I mentioned, sometimes the act of getting information is a lot more laborious and a lot more intensive than I expect. I mean, I've never been an investment manager anywhere else, but than I expect it would be in the UK, for example. You have a language barrier. You have B, an information barrier. This is why the Tokyo Stock Exchange is really pushing these companies, because a lot of the disclosures are almost meaningless. So they're really trying to make them more sophisticated and get them to understand what it is that that investors need to know about their companies to be able to assess them properly. I think not so much now, as I mentioned, but certainly when I first started doing Japan, it could be a very opaque market, quite difficult to get to know company management. I mean, there were many times when company management, they just refused to see investors. They're just like, nope, don't want to see them. And so how are you supposed to really value and assess a company if you don't have access to that company? Another thing that I think is quite interesting, and this is a very sort of real example because it was reflected in our portfolio recently. So non-core assets, so yes, okay, cash, you can see how much cash there is, you know, investment securities, that's pretty easy to work out. But what about real estate? If they've had real estate on their books for 30 years, 50, I mean, some of these companies are 100 and something years old, right? How do you value that real estate? If they're just valuing it at the price they paid for it, you know, 50 years ago. And so for where we think that there's a clear discrepancy between what the assets are worth and what they're being reported at, we will actually get a third-party appraisal done on those assets. And TSI, which is one of our largest companies, largest holdings, that really came through earlier this year. So they're an e-commerce operator, and we felt that their financial value was 175% of their market cap, partly to do with real estate holdings. And they had an old headquarter building in Ginza, which is, I suppose, the equivalent of Mayfair in London, or Fifth Avenue in Manhattan. And again, it was valued at next to nothing. So we then got a third-party appraiser in. They valued it at about 3 times more than what the company did. But actually, they sold it. And again, of course, we've been engaging hard on this topic, right? They sold it in January, and the price was even higher than the appraisal value we had for it, and it ended up being a third of their market cap. And that's just one building. So these, again, for those who do the work, and I think that is probably a big difference, is like, do those issues exist when you're investing in the UK? I don't know. Exactly. So I think it's that you have to really go, I think, above and beyond sometimes to accurately value these companies.
There's a question here about the risk of investing in small caps, but actually I'll slightly twist that. How do you avoid getting stuck into small companies that actually have real problems, and that's one of the reasons that they're cheap?
So I think that's a lesson learned for a lot of people who've been investing in Japan. In the past, as I mentioned, you know, it got a really notorious reputation for being value trap for exactly that reason. You know, you could pile into a company and think, oh great, of course they're going to give us some of the cash back, or, you know, spin off this non-core business or whatever it is, and nothing would happen. So the way that we try to negate that or minimize the risk of that is that we do not invest in rubbish companies. So we have to have some measure of quality in that business. It has to be profitable. It has to generate cash. It has to have a strong market share on whatever niche product or service or widget that they produce. The idea being that even if, and luckily this hasn't really happened, but even if, let's say, engagement is total dead end and totally unsuccessful, that underlying business is still chugging along quite well. Now we try to minimize the chances of us, you know, having zero impact with our engagement by getting to know the company really well beforehand and testing them out to make sure that they are engageable and they actually do have an opening for us to come in and speak to them constructively. But from a fundamental perspective, the way we try and minimize that is to focus on companies where there at least is a decent underlying business.
And then you talk about TSI and that 175% of its market cap in assets in need, effectively.
Yeah.
How is it possible that these things, you know, that nobody else can spot this? How are you identifying these things that?
I don't know if it's that no one else spots it, but I think I think the process to narrow down that market of 4,000 companies to this portfolio of 20 something is quite a sort of what's the word? It's quite a detailed process. And as I mentioned, before even thinking about taking a position in a company, especially because, we take big positions. If one goes totally, belly up, then that's a serious problem, right? So we have to do a lot of due diligence before. Are there other investment managers willing to do that? Go that step further? Do they have the resources? Do they have the language? Do they have the access to management? Do they have the ability to go to Japan or be in Japan and have that many company meetings and get to know the companies that well? So I think, yes, perhaps other people could do it, but it's whether they are willing to.
Yeah, exactly. To what extent do you think about the top down? So there's two elements to that. So there's the sort of macroeconomic thing of where interest rates are going, how strong the yen is, I suppose Trump tariffs and that sort of thing. How much of that are you looking at when you're deciding what to invest in?
So the stock answer is we're fundamental bottom-up stock pickers, which we are. The reality is, of course, you have to be aware and of what is going on, especially in terms of, for example, now with Trump. I think what is changing in Japan is changing so significantly, coming out of zero interest rate policies, the fact that, as I said, you have this big coordinated effort by all these entities, including the Bank of Japan, to really get the stock market going. In terms of what's going on with Trump and tariffs, yes, that's probably going to be, really bad news for a lot of large cap exporters, which have been enjoying the weekend for the past 2 years. But how we look at it is, we would probably never invest in a company that had their operating profits swung so largely by an external factor that we can't control anyway. So whether that be the yen or interest rates or commodity pricing, when you are an engagement strategy or you're an activist, to invest in a company where no matter what you do in terms of engagement, that external factor is going to have a much larger impact on profits, then that becomes a risk that you probably don't want to take on in terms of your investment.
And the other aspect of that is looking at sectors, and you can sort of see that you're not looking for growth sectors and things, but you've got things like Atsugi in there. It's a textile company. It's that sort of most old-fashioned you can get. I mean, is there any kind of sense of thinking, oh, actually, e-commerce is growing really well, so let's go after something like Beano's? Was that?
Yeah, I mean, no. It starts off on the premise that I mentioned at the very beginning. Are they valued cheaply? Are they overcapitalized? Are they unknown? And do they have some quality characteristics of them as well? So that is what we start with. And if e-commerce pops out of that, great. If it's a textile company, okay. It's we are very cognizant that we wouldn't want to have half of the portfolio in a certain sector. But equally, if there is a lot of interesting companies in one part of the market, then why not look at that? So for example, we had a really successful story with a logistics company last year called Alps Logistics. It was a parent-child subsidiary situation. It was taken over at a big premium. And that is because there's a lot of it's a very fragmented industry with a lot of very asset-rich small companies within it, and a lot of these relationships between parent-child subsidiaries, cross-shareholdings. So there's a lot of potential there to make that part of the market more efficient. And we have found, two new companies for the portfolio, both of which happen to be in the logistics area. So that is somewhat informed by external factors in terms of what's going on in that sector particularly. But yes, I think the answer is you have to be aware of what's going on, and you have to be aware of the risks inherent with what's happening outside of, the world of Japanese small cap equities. But that is of course part of the investment process as well.
And then I've got the logistics side up here, but it's interesting that it's private equity buying that. What's changing with that? Why are private equity firms starting to invest in Japan now when they weren't before?
So it seems like they've all sort of come out of nowhere, but they have been there for, especially the big global players. I'd say about 5 years ago, I started hearing that they were setting up offices, they were hiring people. So in a similar way, right, we started our strategy really, 10 years ago, when we started thinking about, okay, we're going to lay a foundation to invest actively and in a dedicated way in Japan. They probably saw the same signs as well, right? And they have been allocating more and more dry powder to Japan. And as I said before, where else in the world do you have this kind of opportunity set for private equity? It must be really fun to be private equity in Japan at the moment, in the same way it's really fun for us to be trying to find these companies. Because there's just so much opportunity there. And I think what's also really encouraging is it's not just the big global players like KKR, Apollo, whoever. There's a really healthy domestic private equity industry that started up, and they are focused very much on the small cap market where we are. And that's been great as well, because as someone who's Japanese or half Japanese, I'm like, I want Japanese investors to reap the benefits as well of what's going on in Japan.
Yeah, fair enough. Obviously with this, you get a bid, fantastic premium, that's an obvious sign to exit. But otherwise, if you've got something where you've engaged with it and you think you're getting success, what makes you decide to sell something?
Well, it'll be a number of things. The ideal situation is that, of course, we've reached what we consider fair value in the company. When we go into these companies with these very large presentations, as I mentioned, it's a very clear roadmap of not just what we want to work with the company on, but what the timeline is. And if we feel that we have reached the end of that timeline and we've actually achieved what we want to achieve, that's the best reason to exit. It could be, for example, we had a company recently who we got out of because they had originally, when we first invested with them, had a lot of cash on the balance sheet and a lot of work to do in terms of shareholder communication. Their shareholder communication didn't really get any better, and they ended up using a lot of the cash on the balance sheet for what we thought were not very additive reasons in terms of their capex, in terms of M&A, etc. And so, yes, exactly. So if you look, net cash was 22% of market cap, and it went down to 7%. The valuations went up quite significantly. I mean, we made a decent return on it, but we felt that the cash could be better deployed elsewhere. There are so many other exciting opportunities out there.
Yeah, that's fair enough. And then there's a question here about buybacks. But actually, I think that's something else. So the other thing that you've seen is a lot more dividends.
Yes, dividends and buybacks. If I can take you to where are we? Page 17, please. I know that the takeover bids and private equity gets a lot of airtime because it's all very exciting and big premiums, and isn't that wonderful? But I think 17.
Yeah, that's all right. I just can't see the numbers.
There we
go.
Oh, hang on, you've got a different one than me. Okay. Oh, can you go back up one? So it's probably 16 on yours. Thank you. I think what's really encouraging that it's not. I mean, yes, TOBs are exciting, but what's been happening is that we are seeing a really regular and impressive commitment by companies to increase dividends and also to do buybacks. So we had 6 companies, I think last quarter, last quarter, in the past year, who've done significant buybacks, for example. Part of what we engage on is really around having companies commit to a dividend policy. Otherwise it's a bit finger in the air. We don't really know what they're going to be doing. So that's something that we work on with the companies as well. And yes, we've been having a lot of success with that. I think as a market as a whole, Japan's total shareholder return now is at historical highs if you take buybacks and dividend increases into consideration.
Great, but still cheap.
But still cheap.
Yeah, exactly. Good. All right then. I think we've covered a lot of ground here. I'm just trying to think if there's any questions we haven't actually addressed here.
Yeah, sorry. As I said, I got back last night, so I'm super over caffeinated and probably spoke at 100 miles an hour. But yes.
Risks? Do you see any risks going forward?
For Japan as a whole, you mean?
Well, for strategy, actually.
I mean, so what I really liked about the strategy when I was looking at it and deciding, to come and join AVI is that the process is so solid, and because you have that underlying quality characteristics of these companies, the portfolio doesn't get swung around as much as a lot of other types of strategies by things that are happening outside. So you don't have, so when the strategy has had negative performance, for example, it hasn't been like a massive drawdown like you've seen in other strategies. It's a very resilient portfolio, I think. So in terms of single stocks and single portfolio companies, as long as we keep doing what we're doing and we understand the companies really well and we're working with them in a very intensive way, then I feel pretty confident. I think it's more what's happening outside of Japan, to go back to your point about macro and how people feel about Japan as a market, that might inform especially the larger cap area of Japan. I think there's just so much volatility at the moment and so much uncertainty with what's going on with Trump and tariffs, and it is. I would definitely be concerned if we were focusing more on that part of the market, but where we are, we're relatively insulated by what's happening. So, the hope is we just keep doing what we're doing. The companies keep working towards increasing their valuations, are happy to work with us.
Yeah, exactly. This is what I was thinking. It's kind of like a self-help story. You
Absolutely, that's exactly what it is. It's self-help, and we're like the therapists helping them get there.
Brilliant. Thank you very much, Nicola. That was really good. And we covered a lot of ground. So we'll get you back on again in a year or so and see how it's all been going. But hopefully another year of the same.
Yeah, well, thank you very much for your time again.
So we'll be back next week, and we've got the CEO of the AIC on, so Richard Stone. So plenty to talk about there. There's obviously a lot going on with the industry, and that should be quite interesting. So I see you next week. Have a good weekend. In the meantime, bye.